You know that feeling when you're watching a chess match and the underdog makes a move so unexpected that even the grandmaster pauses for a second? That quiet moment where everyone realizes the game may have just shifted? Something similar has been unfolding on the global economic stage. And if you care about your money, your job, or even the price of everyday goods, this matters more than it might seem. Because this wasn't just political theater, it was a high-stakes trade dispute, one that reshaped conversations about tariffs, supply chains, and global partnerships. For weeks, it appeared that the tariff strategy introduced during Donald Trump's administration was dominating the board. The approach was direct and assertive. Use tariffs as leverage, apply pressure, renegotiate terms. It was a bold strategy, and in many cases, it forced conversations that had been avoided for years. But then, another perspective entered the picture, one associated with Mark Carney, a figure known more for financial strategy than political confrontation. Now, before we go further, this isn't about heroes and villains. It's about strategy versus strategy. It's about different philosophies of economic power. Trump's trade philosophy was straightforward. Tariffs can be used as tools to protect domestic industries and strengthen negotiating positions. Supporters viewed this as standing firm. Critics saw it as escalating tensions. Either way, it reshaped global trade discussions. Carney, on the other hand, is known for a quieter approach. As former governor of the Bank of Canada during the 2008 financial crisis, and later governor of the Bank of England during Brexit, he built a reputation for stability under pressure. His style isn't confrontational, it's calculated. Instead of responding with matching tariffs or public rhetoric, the alternative strategy focused on engagement. Conversations shifted toward business leaders, supply chain experts, and industry groups, the people directly impacted by trade disruptions. Rather than escalating tensions publicly, the emphasis moved toward highlighting real economic impacts, rising input costs, export barriers, and supply chain adjustments. These discussions gradually influenced broader business conversations in North America and beyond. The second major shift involved diversification. For decades, the United States has been the central pillar of global consumer demand, but global growth patterns have been changing. Emerging markets in Asia, Africa, and Latin America now represent expanding middle classes and new demand centers. So instead of focusing solely on North American trade channels, efforts increased toward building broader partnerships, infrastructure agreements, technology collaboration, and long-term supply arrangements with countries like Indonesia, Kenya, and Mexico. This wasn't about replacing the U.S. market. It was about reducing dependence on any single market. In economic terms, it was risk management through diversification. The third shift centered around long-term investment, infrastructure, logistics networks, digital connectivity, and energy systems. Framed not as retaliation, but as modernization, these initiatives emphasized growth and stability. Infrastructure investment has wide appeal because it creates jobs, improves productivity, and supports long-term competitiveness. By focusing on investment rather than confrontation, the conversation moved away from short-term tariff battles and toward structural economic development. Now here's why this matters to you. Trade disputes aren't abstract policy debates. They influence supply chains, interest rates, commodity prices, and employment stability. When tariffs increase costs for raw materials, those costs often move through the system into manufacturing, retail pricing, and eventually household budgets. At the same time, diversification strategies can create new opportunities. When companies expand into new markets, they reduce exposure to single-country shocks. That can mean greater resilience during economic uncertainty. The broader takeaway isn't that one side won and the other lost. It's that global economics is shifting from a model centered on confrontation toward one increasingly focused on networks and interconnected markets. The 21st century economy isn't just about borders. It's about supply chains, data flows, infrastructure corridors, and financial systems that span continents. Some leaders emphasize leverage, others emphasize integration. Both approaches shape outcomes in different ways. What we're witnessing isn't simply a tariff dispute. It's a debate about how economic power works in a world where growth is no longer concentrated in one region. And the people who understand that shift, investors, businesses, workers, are better positioned to adapt. If you want to follow these shifts closely, stay with the lost economy. Because beyond the headlines and daily drama, the real story is about how global systems are evolving and what that means for everyday life. For decades, the global financial system has revolved around the US dollar. It dominates trade settlements, foreign exchange reserves, and international borrowing. According to the International Monetary Fund, the majority of global reserves are still held in dollars. That dominance gives the United States enormous leverage. When trade tensions rise, access to the dollar system becomes part of the equation. Sanctions, liquidity, financing costs, they all connect back to currency power. But here's where things get interesting. When countries expand trade relationships outside a single dominant market, they experiment with alternative settlement systems, not necessarily to replace the dollar, but to reduce dependence. This isn't dramatic, it's gradual. Regional trade agreements increasingly use local currencies. Bilateral swap lines expand. Central banks quietly build currency buffers. Financial coordination between Asian economies has deepened under frameworks supported by institutions like the Asian Development Bank. Europe strengthens euro-based settlement mechanisms through institutions aligned with the European Central Bank. Again, this isn't rebellion, it's risk management. And when enough countries pursue risk management, the global system becomes more multipolar. That changes trade wars fundamentally. Tariffs only have maximum impact when the target economy has limited alternatives. If exporters can redirect goods, investors access diversified capital markets. If trade disputes can be resolved through multilateral frameworks, then the power of unilateral pressure weakens. Markets understand this before politicians do. During heightened tariff tension, volatility spikes. But when credible alternatives emerge, markets stabilize. Investors look for predictability. Businesses look for supply chain security. Workers look for job continuity. And central banks look for stability. Which brings us to the real question. What happens when strategy replaces confrontation? The answer is subtle but powerful. Instead of escalation cycles, you get economic adaptation cycles. Companies diversify suppliers. Governments hedge exposure. Financial systems create redundancy. Redundancy might sound boring, but in economics, redundancy equals resilience, and resilience is the ultimate competitive advantage. Now, let's address something important. None of this means trade tensions disappear overnight. Major economies will always compete. Strategic industries will always be protected. Political cycles will always influence economic policy. But the difference is this. Competition within rules is very different from competition without rules. When institutions like the World Trade Organization function effectively, disputes are processed. When they weaken, uncertainty grows. The countries that invest in strengthening systems, rather than bypassing them, often gain long-term credibility. Credibility lowers borrowing costs. Lower borrowing costs fuel investment. Investment fuels growth. It's a chain reaction. And here's why this matters to you directly. If global trade becomes more diversified, supply chains become less fragile. Price shocks become less severe. Inflation pressures ease faster. Investment opportunities spread beyond a single market. Your grocery bill, your mortgage rate, your retirement portfolio, they're all connected to these macro shifts. We often think economic power is about domination. In reality, modern economic power is about connectivity. The countries that build bridges, trade bridges, infrastructure bridges, financial bridges, create options. And in economics, options equal strength. Now here's the bigger takeaway from this entire situation. Short-term tactics can move markets for weeks. Long-term strategy moves markets for decades. The global economy is transitioning from a single center system to a multi-node network. Not overnight, not explosively, but steadily. And when you understand that shift, you stop reacting to headlines and start watching structural trends. That's where the real advantage is. In part 3, we're going to break down what this evolving global structure means for the future of the US dollar, emerging markets, global supply chains, and where smart capital might flow next. Because the next phase isn't about trade wars, it's about economic positioning. And the positioning phase is already underway. Stay strategic.